What is the profit margin in Murabaha contracts? Have you ever wondered how profit works in Islamic finance? Specifically, what is the profit margin in Murabaha contracts? Let's break it down in simple terms. In a Murabaha contract, the profit margin is a fixed markup that is agreed upon before the sale takes place. This means that both the bank and the customer know exactly how much the profit will be from the start. This approach ensures transparency and fairness in the transaction. Murabaha is a type of cost-plus financing. Here's how it works. The Islamic bank purchases an asset and then sells it to the customer at a price that includes the original cost plus the agreed profit margin. The customer pays this amount over a set period, usually through a deferred payment plan. Unlike conventional loans that charge interest, the profit margin in Murabaha is not considered interest. Instead, it is viewed as a legitimate profit from a sale, which is allowed in Islamic finance. This is important because charging interest, known as Riba, is prohibited in Islamic law. Now, let's talk about how this profit margin is determined. It is fixed and agreed upon in advance, so both parties know the total cost and profit before the transaction occurs. The margin compensates the bank for buying and reselling the asset, covering costs and providing a reasonable profit. Another key point is that the bank must actually own the asset before selling it to the customer. This means the bank takes on the risks associated with the asset until the sale is completed. The profit margin is considered a permissible markup under Islamic law because it arises from a genuine trade transaction. If there are any late payment fees, they are typically not treated as additional profit. Instead, these fees may be donated to charity or waived, depending on the interpretation of Islamic principles. The size of the profit margin can vary based on the type of asset, market conditions, and negotiations between the bank and the customer. It is essential that the margin is fair and transparent to avoid any exploitation and to comply with Islamic ethical standards. In essence, the profit margin in Murabaha contracts is a clear, upfront agreed markup on the cost price. This reflects a sale profit rather than interest, aligning with Islamic finance rules that prohibit riba while allowing trade-based profit. Understanding this concept can help you navigate the world of Islamic banking and trade finance contracts more effectively.